Hi, this is Daniel. You're watching Unrivaled Investing. This is a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. I want to do a follow-up video, this time on Spotify. I did a video earlier this week on Bill Ackman's SPAC, PSTH stock, which is buying a stake in Universal Music Group. I think Universal Music Group is actually a solid company. The risk reward may not be super compelling, but it is an interesting setup. Whereas here, I'm interested in understanding Spotify, and as I've dug deeper, I am a little bit concerned about the risk reward and the valuation. But let's first talk about Spotify, the business model, what they do, and sort of understanding what you can think about if you're investing in Spotify SPOT stock. What do you think that hypothetical risk reward could look like in the years ahead? So let's dive right in. Or once again, this is not my first video covering sort of the space. I just this past week did a video on Universal Music Group, which about 10% of the stake is being acquired through Bill Ackman's SPAC, PSTH. And the part of the crux of Universal Music Group is that their streaming and subscription business is growing at a very nice clip, mid-20s over the last 5 years. And that really has been the key growth driver for Universal Music Group, as their consolidated revenues growth is much slower than what they're seeing in streaming and subscriptions. And you can see streaming and subscriptions have grown to over half their business. So effectively, the Spotifys of the world paying them money to get access to their library, to get access to the artists, their content creators. And this is ultimately, streaming is ultimately what's driving the music industry's growth, because for several years, you could look back at LimeWire and Napster. The music industry faced a serious problem as people didn't want to buy, these music CDs for $20, a CD, and people want to say, hey, there need to be a new model. Piracy started to turn into a real problem. And so streaming is arguably the salvation of the music industry, and it's nice to see that it's growing at a good clip. And so Spotify, they claim to be the #1 global audio streaming service by subscribers, with 158 million around paid subscribers, 356 million monthly active users. So that includes effectively their free users as well. 70 million tracks. Just shows you what a huge content of library. You arguably probably couldn't listen to that whole thing in several lifetimes. And then Spotify is available in 178 different markets. So think about, this is a global company that's trying to roll out around the world, trying to tap into the inherent desire to listen to music, no matter who you are, where you are around the world. And so what's their business model? How should you understand this? And one should understand it as it's trying to get people's initial interest by having something for free. It's the freemium model. Listening is everything, no credit card needed, just sign up for free. And arguably the theme that I keep seeing when I've been doing my due diligence on Spotify is a lot of people say it's the best algorithm. It's the best for finding my taste in terms of music and what I like. And it's just amazing that we live in a time where arguably one of the best computer algorithms for identifying your taste is effectively available to you for free. The main cost is having to listen to a few sort of ads that are inserted into a playlist or into a stream that you're getting. And that's simply incredible. And how do they enhance it? How do they keep growing if you have the top of funnel that's free? And so, well, they need to make exclusive content. So that way people go, oh, okay, well, I'm willing to listen to ads on your platform. I'm willing to listen to ads on other platforms. Well, what's going to ultimately push you over if it's free for a lot of folks? Well, you need to start considering exclusive content. For example, they paid more than $100 million supposedly for getting access to Joe Rogan and the Joe Rogan Experience, which is the #1 podcast on Spotify's platform. And so that's part of the push. Let's enhance the top of funnel, getting better and better content for free. And they've made several acquisitions in the past few years trying to make the appeal of everything audio going through Spotify. I'm not going to go into deep detail on some of these acquisitions, but it fits this broader theme of, hey, we want to be the everything audio company and everything audio platform. And so you start free, and the goal is that you convert into premium. At least that's their goal. And so they quickly, there will be ads in your listening to say, hey, why not, upgrade to a premium account? And you could see things like get 3 months of premium for free. Now, why would someone want to switch if you're perfectly fine with a free account? A few different things. I mean, there is some enhanced functionality that people really like being able to download the music if you're, going to be in a spot with, poor Wi-Fi or something like that, no ads. You can pick any song in their library, even on mobile, and that there's unlimited skips. If you don't like what the algorithm is dishing up, you can say, you know what, I just want to skip it. Whereas in the free settings, you sort of have to stomach whatever they serve you. You only get a few skips. Here it is. You can just go, oh, this is not what I'm interested interested in. Let's move on to this next one. And so this is the premium experience that they're offering. This is the main value, I'd argue, of premium. And now how much is it? And you could see, based on a range of programs from a few bucks to a family plan that accounts, for 6 different accounts, it's about $16 a month. Either way, on a per individual basis, you're looking at like $5-6. So it's really, in my opinion, it's a smart way to get them. And, having a student plan that ties into Hulu and Showtime, this really does reflect that they're trying to hook them young and then build this playlist, build this algorithm that says, hey, this is what I like. I'm just going to stick with them because they know my preferences. They know what I want. So I appreciate these sort of efforts to win no matter what. And what's interesting, though, is don't get too hooked onto these figures, that I said $15.99 for a family or $9.99 for an individual, because if you look at the average revenue per user for premium around the world, it's actually much lower, and it's been going lower, which makes you ask the question, well, wait a second, isn't that a warning sign that it's been going lower? Actually not. In this case, it's a reflection that they've been actively pushing to have sort of a global expansion. And when you want to take share and sort of put your foot into a new marketplace, sometimes it's going to be a lower revenue price point versus, let's say, in the United States, which is going to be a much higher price point. So globally, it's much lower prices, and that's the reason why you've seen this trend. But broadly, you should see a consolidated revenue figure growing at a nice clip, and we'll talk about that in a second. And so you can see here, what's really driving this business, and you can see 356 million active users, monthly active users, of which 158 million are these premium subscribers, and then the ad-supported are this other 208. So this is really what's driving this business, is these premium and ad-supported. And you can see how the business is really split up. So most people just aren't willing to make the purchase, willing to say, hey, you know what, I'm fine listening to ads. I like the algorithm as is. But you can realize quickly looking at their revenue, which is financials, their revenue driven by premium versus ad-supported, you can see, and this is in the first quarter of 2021, that about 90% of their revenue came from premium, people paying for the subscription. So premium users are just exponentially worth more than ad-supported monthly active users. It's just a night and day difference. And one could argue premium is the business, just looking at their gross profit. See, this is looking at their revenue figures, but then you have to actually think, well, wait a second, we need to back out their cost of sales. So what's the gross profit? And looking at it, you look at this, and premium is like 99% of their gross profit in 2020. In 2019, it was like 95%. So premium, the conversion from free to premium is the heart and soul of this business. Now, part of the reason why this ad-supported gross profit has been declining, I think it's attributable to the fact that they've been trying to make their platform more and more exclusive with content that effectively is exclusive, but it is ad-supported at the fundamental level, like the Joe Rogan experience, where you're buying it, that expense is, let's say, going to be offset here in ad-supported versus necessarily the premium content. That's at least how I'm thinking about it. The part of the reason why this is lower, they're trying to make freemium, get more and more people using it, and if ad-supported effectively goes to zero, it's not great, but ultimately if that drives more and more people to use premium, and that's what generates the vast majority of their gross profit dollars, then that's really business. So what is the cost of sales? When you see that their gross margin's 28%, so 70 cents of every dollar in revenue is going outside of them. This is not a traditional like software as a service type business. This is not a high margin business by any means. And so when you think about it, and look at their filings, they talk about how the cost of revenue consists predominantly of royalty and distribution costs. And this makes sense. This gets back to the Universal Music Group. They have the library of content, so you need to pay royalty costs. So they talk about how we incur royalty costs, which we pay to certain record labels, music publishers, and other right holders. Once again, thinking about Universal Music Group. Generally, premium service royalties are based on the greater of a percentage of revenue and a per user amount. That's a really interesting line. I'm going to repeat it. So based on the greater of a percentage of revenue and a per user amount. So they're effectively saying they pay as a percentage of whatever dollar they get for said user. That's really interesting to me because that reflects, it's almost like a direct pass-through straight to these music publishers, straight to Universal Music Group, which does make me think it's going to be tough to get leverage on their profit margins longer term. They talk about how the royalties for the ad-supported service are typically a percentage of relevant revenue. So once again, the ad revenue that you're getting, they're paying based on the amount of ad revenue they're getting. That money, the ad revenue, that's going directly to the music publishers. So they're, let's say 70 cents or 70 cents for every dollar. That's also going through. So I think it's a really interesting setup. It makes you realize how just connected these businesses are. The fact that they're getting a percentage of revenue. There are sort of milestones of saying, hey, you have to do a minimum of this and you have to pay this amount. But broadly talking about the greater of a percentage of revenue, that is a key line to think about. And when you look at it, so you have Spotify and they're connecting with effectively 4 major content providers: Universal Music Group, Sony Music, Warner Music, and Merlin, which is the vast majority of the music library that Spotify's using. All this content, the 70 million tracks that they're talking about, where they talk about how their content, looking at these 4 different music publishers, their content was 78% of Spotify's music streams. So that is a huge percentage here. And this does mean that while Spotify, being the number 1 player, is going to have a lot of leverage, they also are going to have a lot of leverage because it is concentrated. The amount of critical music is concentrated in arguably a select few hands. And this gets back to the idea of like, hey, Universal Music Group owns, let's say Universal Music Group owns the Beatles, has a license to that. And so in that case, if you want to listen to the Beatles, and Beatles is, let's say popular throughout time, then they're going to have that pricing power each year and say, hey, we're going to push it a little bit each year, or next time our contract's up, we're going to say, hey, we want to get a little bit more for that. And that's going to become a real give and take, because Spotify, I'm sure, is going to say, well, wait a second, this is how many times it was listened to. Our other content library, is growing this fast. But at the end of the day, even though they're the number 1 player in music or audio streaming, I don't think they want to lose key licensing, key content like the Beatles or like Lady Gaga. And so that's a key theme to think about, which is the concentration of this content in a handful of providers. And so the other side, looking at the other side of the equation, is not only do you have some sort of concentration with the content or effectively your suppliers, but you also have a lot of competition for getting those free users like Apple Music or Amazon Music or Pandora or Tidal. There are a lot of streaming music options. And, my personal choice is actually YouTube Premium, and I'm not paid at all or anything to endorse this. I'm actually just sharing my own personal, because I think it is a worthwhile anecdote, because by using YouTube Premium for a similar cost amount per month, maybe a slight premium, $1 or $2, I get the same perks for YouTube, where I can download videos. The videos are ad-free. I can also get the music as well. And I'd argue I'm a little bit of a different user, because when I listen to music, I like to repeat one thing over and over. It's less about exploration, which that's a key angle that Spotify's encouraging. Like, I've listened to The Gladiator, 3 songs from the Gladiator soundtrack on repeat, I think over 10,000 times. And that's like how I like to zone out or zone into making these videos and thinking about it. I just put that on and rinse and repeat and, read a ton. And so that is quite different. And so it's just something to consider in terms of what else is out there. And it does make me think, if you're looking at these different options and you realize the price points are comparable, it is a little bit tricky to say you're unrivaled. Now, you might have a strong algorithm that you might build, but it's going to be tough. And there are ways that Spotify's trying to do to make themselves sort of unrivaled or make themselves stand out. And we'll talk about that in a second, such as their sponsored playlist, where they're thinking about this effectively this 2-sided marketplace, where what they're trying to do is say, hey, you know what? We create these specific playlists that people can click on. And if artists opt in to use, to effectively give us a discount on the royalty rate, then we will include their music in our playlists. And the advantage of that is that, A, you don't have to be a major artist to be successful. You don't have to pay a ton of money to get on their platform, to get people's attention. You just have to enhance their margins. And so that is an interesting take. So they talk about how fresh finds, the Spotify's new Fresh Finds program helps independent artists build their careers, because they're saying, hey, you lower that royalty rate, the amount that we have to pay you, and now you're on the platform. And this is the angle that they're leaning in, is saying, hey, how do we figure out more and more clever ways to get either sponsored playlists or sponsored songs, or put you on our own customized playlist? And so they're trying to create this other aspect where the content providers are effectively bidding to get your ears. And if they're successfully bidding to try to get in front of you, that could be an advantage for them and for Spotify, because now their margins will get enhanced, and they get, they may now have an audience that they weren't expecting. So they talk about how Fresh Finds see their average monthly listeners increase by 108% in the 28 days following their addition to the playlist. That's a big win if you're a young artist that's just starting out looking to get some recognition. And as I mentioned already, that does sort of level the playing field, because it can be through a way of margin, so a discounted royalty rate, versus having to pay a large amount up front. And then they're doing other things, other clever initiatives to strengthen both sides of their business, both appealing more to the consumer that's listening to it, as well as the artist, by saying, hey, we like to thank artists big as Spotify fans with access to unique and exclusive offers, such as pre-sale tickets for upcoming concerts or exclusive merchandise items. And they say, look, this is open to everyone with a Spotify account. Once again, trying to enhance the top of funnel, so that way free users feel compelled to sign up. Even if you're not paying for premium, they're saying, look, you don't even need to pay for premium. Just be a free Spotify user, and if we can tell that you're one of the biggest fans, you'll get access to things like a concert or exclusive merchandise. So this does make it stickier, and arguably might put them in a competitive position, or an unrivaled position, relative to their competitors. Now, I don't like the fact that their competitors are able to bundle it with other things, like I already mentioned YouTube. YouTube Premium is effectively bundling it with video, and a lot of people would say, hey, I'd love to not get ads in both video and music, and that's what they're doing. So that is a challenge. So it's a trade-off of, one is sort of pure focused on the artist and trying to make the experience richer and richer. The other has a big bundle that they can offer, like Amazon Prime. Now, what about valuation? How should we think about the valuation? And just a quick plug here, which is that if this is your first time tuning in, my name is Daniel, you're watching Unrivaled Investing. And if you want to follow my personal journey as I look for potential multi-baggers, or the types of stocks that I think could potentially go up hundreds or even thousands % over time, go to unrivaledinvesting.com, click on Journey. First week of the month, I call out my full portfolio overview of my top holdings. And then once a month, I call out a potential multi-bagger, at least once a month, a stock that I do think has that type of potential upside. And then each week I give sort of a weekly update of my thoughts or any sort of activity. And there's also an exclusive content that's getting built out. You can click in the sheet below, as well as a dedicated community of like-minded investors, a Discord community that they would eagerly be looking to talk to you if you decide to join. So that's unrivaledinvesting.com. Click on Journey. Let's dive back into Spotify. And so as we look at Spotify, how do we think about the valuation? We need to understand, where can the margins go? And the first step is to understand, well, wait a second, what are the gross margins here? And is there a lot of room for improvement? And the reality is it really hasn't improved over the last 3 years. It's been around 25, 26%. They're even guiding to around like 23 to 26%, I think, for the next quarter. And so it's a question of like, well, could ad-supported rebound a bit? Would that actually move the needle? And, one needs to recognize that, Bill Ackman, he's making this bet on Universal Music Group. He wants that to be a home run investment. And he's going to say, look, you have this premium asset, like the Beatles, like Lady Gaga, and we're going to want you to be able to price that and get pricing power that's commensurate with that. And so I wonder how much flexibility you really have here over time to really leverage this higher. And if I were to invest in this, I would want to see that they're getting the scale, that they're getting that leverage, that it's going from 27 to 30 to 35 to really start making that case that, hey, this business really does have the potential for margins to improve. I'd want to see that in their numbers. And so far, I'm just really not. And you're sort of at this conflict of like, well, wait a second, your margin benefit here, the cost is really going to come from the content providers, which is pretty concentrated with 4 players representing about 80% of music streams. Or you can do some sort of tricks with like advertising and playlists, and maybe that enhances it slightly. We'll see. I'd say at so far, the data doesn't really suggest that this margin gets, to 30% or 45% or 35%. So it's hard to make the case like, hey, this thesis, you should have much higher margins. I mean, maybe you get a few percent, based on some of the initiatives they're doing. So let's keep thinking like, where can margins go? Because keep in mind, they are technically unprofitable right now. They're free cash flow positive because of stock-based compensation and working capital. But other than that, this is a negative operating profit business. This is a loss-making business. And so you look at, research and development expenses. So this is, they're constantly laying out new initiatives, trying to make it a better app, rolling out into new markets. So maybe at maturity, this can be, high single digits, mid single digits. So maybe you can squeeze a few percentages here as it gets bigger and bigger. Maybe you can squeeze a few percentage out of sales and marketing, currently around 12, 13%. Maybe if Spotify becomes ubiquitous, you can squeeze a few percent. I honestly think that will be very tough to squeeze a few percent here, given the fact that they're competing against several major bundles where they do not compete against a Prime bundle in terms of saying, hey, I want same day shipping, or with YouTube where you say, hey, I want ad-free YouTube videos. So that, I think they're not going to be able to squeeze this as, I would suspect they're not going to be able to squeeze this as much as they like to be able to retain growth. And maybe you can squeeze a couple percent. I mean, look, it's already at 5-6%. How much can you really squeeze here in terms of general and admin? Maybe you can get it 2-3%, maybe. And so all in thinking about how much could you squeeze out of each of these, maybe high single digits, low teens, incremental margins that you could get versus their negative operating margins now. So if you think, high single digits, low teens operating profits long term, then you could start, sort of laying this into some sort of valuation sheet. And this is my hypothetical valuation framework, where you can see the current price around 242 euros per share, around 46 billion euro market cap. Implied growth for this next year around 16 to 24% for 2021. Optimized margins, and this is the figure that we were just talking about, is what do you think their margins could be long term? And I'm saying like 6 to 12.5% versus negative right now. How do you want to price this? What do you think this could be at maturity? Assuming that they were at these margins now, it would imply, and assuming a 15% tax rate, it would imply about 45 to 100 times earnings, assuming that they were at that profitability levels now, which for, teens, 20% growth isn't super compelling in my mind. As I pointed out several times before, I much prefer it when I see a growth rate that is far in excess to the optimized earnings multiple, or this pro forma earnings multiple. So then, given that I'm a long-term investor, I'm looking for things over a 5-year time frame. What do you think is the growth rate in the ensuing 4 years beyond 2021? So, take a high teens, low 20s growth rate, slap on, let's say, a 20 to 30 times multiple for 5 years out, because look, a lot can change in 5 years. And keep in mind, if you're penciling out a 20% annualized growth rate, that might mean that you are at a 20, that you might be at a 15% growth rate 5 years out in order to get to that 20%. You might be above 20% for a few years and then in a teens rate for a few years. So, does 20 to 30 times end multiple, assuming you're able to get to these margins? And based on that, you also have to factor in they do have some sizable cash and a sizable investment in Tencent Music. And so you factor that in, net of debt, and it's effectively a coin toss, effectively saying, hey, maybe there's 60% upside, maybe 50% downside. And honestly, this just doesn't strike me as super compelling. I mean, the risk reward just isn't that great. Now, keep in mind, this is a hypothetical valuation framework. Of course, stock prices go way higher, way lower. But if you're thinking that if you're a shareholder in Spotify, I'd love to hear your thoughts in the comments below. I'm not trying to dig on the stock, but I'd love to hear what are the assumptions you're making that make you think, oh yes, this definitely should be higher. Now, some people could say like, hey, your earnings multiples are just way too low. And I've mixed minds about that. If you look at the valuation multiples from 2017, then everything here would get cut significantly. And 2017 wasn't that long ago. So, and it's not like 2017 was a depressionary market environment. And so I look at this and I'm just not crazy about it. This isn't the type of investments that I look at where it's like, hey, I want to find something that's asymmetric, where maybe I can make a little on the low side and I can make a lot on the high side. And that's ultimately what I'm looking for. And, it does sort of raise the question, as I've been reflecting, and I have been reflecting more and more on Bill Ackman's PSTH SPAC, and I have an updated UMG valuation that I'm going to talk about in a second. So if I had to pick between UMG, or the Universal Music Group, 35 billion euro valuation, and Spotify, if I had to make a pick, first of all, I want you to tell me which one you think you'd want to pick if you had to choose between the two, because they both have their own different pros and cons. One has this sort of exclusive library versus the other, which is sort of the leading streaming provider. But if I had to pick between the two, I'd actually be more inclined to pick Universal Music Group. And that's not actually where I started off when I started researching this, but as I sort of dug more into Universal Music Group and reflected on what their margins could be, what their growth rates could be, think about those multiples. As I reflected on this, I think at that 35 billion euro valuation that Bill Ackman's considering, I think the downside pretty much is around break even. And I'm penciling out like a 5% growth rate, which arguably is low, given that, the past year it was sort of hit by COVID, so maybe it does reaccelerate, people start going to more events. And I'm assuming a 20% margin, which it's been steadily getting higher each year, and Bill Ackman's like, hey, we can get a lot of leverage there. So if you don't get the leverage that you'd want, and you get sort of market type growth and a 20 times multiple 5 years from now, you factor in the cash flow that the company is generating, which is significantly, this is a profitable business, you're effectively at break even, down about 20%, maybe down 10% when you factor in the cash accrual that's going to you. Whereas if you are able to deliver closer to what Bill Ackman argues, probably thinking like 25 to 30% margins, and you're able to get 10 to 15% annualized growth possibilities, the question is, what sort of end multiple are you looking at? In which case, maybe 50% to 160% upside, throw in some cash accrual, and it gets even better. So I would say the risk reward for UMG at a 35 billion euro valuation is more compelling than what we're currently looking at with Spotify. That's my current take based on sort of updating and reflecting on UMG's valuation. Of course, how this ultimately shakes out, UMG is set to go public later this year, could go higher or lower. I still have mixed feelings about the PSTH SPAC because it's pretty complex. You got a bunch of different pieces. That said, if you've watched my Bill Ackman videos, I think I have warmed up to the UMG valuation a bit in terms of thinking about the risk reward, in terms of thinking about that upside downside. That said, I do think there are some investments that do have better risk reward. I've routinely called out Alibaba as something that strikes me as compelling. One could look at the valuation of Alibaba over the last 5 years, and I think it's at the lowest valuation it's been, and it's still a nice, solidly growing company, solidly free cash flowing company. It's at a time when a lot of people are very concerned about China risks. You can watch that video if you're interested. And then for the Unrivaled Investing Journey subscribers, I did call out in my monthly potential multi-bagger idea in May 2021, a company that's trading below liquidation value that I think has 2 to 3x upside. And that's the type of play that I would like to have in this environment. This environment is a little bit pricey. Things are pretty rich. You have meme stocks going to the moon. And so I'd want an extra level of protection when I'm considering investments at this time, given that sort of frothy environment. And so I do want the type of things where I can sort of have a liquidation backstop when I'm thinking about it, or a compelling valuation like I talk about with Alibaba. And full disclosure, I personally do own shares in Alibaba. And, hopefully this video has been helpful for you, talking about Spotify. If you have a strong disagreement on why you think Spotify should be worth much higher than what I'm penciling out, effectively that's 60% upside, I'd love to hear your thoughts in terms of what margin assumptions, what growth rates you think, or what initiatives you think can sort of reaccelerate their business that I haven't really gone into full detail here. But at the end of the day, I'm looking at this and I just don't think it has that super compelling risk reward. If this video has been helpful for you, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.